A recent study came out that 47% of Americans who make $150,000 a year to $200,000 a year are living paycheck to paycheck.
I'm so tired of living paycheck to paycheck. I just waited for the mailman to show up so I could get my paper check in the mail.
It is impossible to save right now.
How are y'all making it? No, literally, how are y'all making it? Because, little backstory,
I think we're seeing a U.S. economy that is deteriorating.
We're about to go through one of the worst recessions in U.S. history.
Online shopping sees biggest slowdown in over a decade as tariffs disrupt e-commerce. Amazon reveals Americans have hit the breaking point, forced to cut prices, but not pleasure, with the latest Prime Day sex toy and lubricant deals. And you won't believe what the Fed just said about interest rates. Or better yet, what President Trump just said about Fed Chair Jerome Powell. I'm sure he would love for him to go and
first, take a big step back and literally fuck your own face!
President Trump posted this that says, or at least Eric Doherty's shared how President Trump says Jerome Powell is costing the United States nearly $400 billion per year by keeping interest rates at least 3 points too high. Lower the damn rate.
I think of it as different sickly canaries that are appearing in the coal mine. They're not dead yet necessarily, but they're showing signs of real illness. And we're likely to see more, I think, as the year progresses. First of all, consumer confidence has taken a hit. What we're seeing also is just signs of reduced consumption. We're seeing a pickup in continuing jobless claims. We're at the highest level since November of 2021. So all this says to me is it's not many canaries yet, but I think what it's telling me is that this economy is deteriorating.
Overall, consumer credit rose by $5.1 billion, which sounds like a lot, but it's not really. It was half what was expected. Inflation has become a problem again for consumers, and Market Watch says that cohort is going to keep driving the market higher. JP Morgan Chase says our call of the day from JP Morgan, which predicts that retail investors will lead a $500 billion wall of money flowing into the U.S. stocks in the latter half of this year, driving gains up by 10%.
Are we really struggling in this economy, or is everything a facade?
What happens in the worst case scenario if the economy crashes?
I published a piece today talking about how we don't need to destroy the economy in order to save it. Americans often don't realize how good they have it, despite all the problems that we do have.
I don't hear too many people talking about how the United States is repeating history for a second time, with us entering into a period of what's called fiscal dominance. This is similar to what happened post-World War II, before the bear market between 1946 and 1949.
And I don't hear a lot of people talking about this. For instance, how U.S. consumers shunned credit cards in May and borrowing cooled, which we talked about earlier with that $5.1 billion in U.S. credit card spending, which is half of what was expected. This isn't necessarily a good sign or signal, folks. Even though spending less on your credit cards could mean that you're taking better control of your financial life and responsibility and any impulse you may have or addiction maybe. And why I'm seeing stories like these of not just a downward trend in e-commerce and a last minute Hail Mary attempt for Amazon to try and make some money on Prime Deal Day. People saying how they're saving 100% on Amazon Prime Day. And you can too by essentially not buying anything. Like, this is demand destruction. Pay attention here, folks, because I think they're saying the quiet part out loud. And in fact, I'm going to tell you exactly what that is in just a moment. But first, Jeff Bezos is selling off his shares of Amazon. So far, $666 million in Amazon stock as part of a plan to unload 25 million shares. This should get your attention. This is far more important and bigger than perhaps maybe what is being talked about on mainstream, if we read between the lines here, which is what we do in the community. Hope you guys are going to join soon. Market Watch says consumers are still struggling as inflation is a problem again. And it's interesting how the consumers that are struggling are associated with Duncan Hines and Slim Jim and Swiss Miss, and these are not necessarily healthy food staples. The consumers that are struggling are those that are more likely to engage in buying and eating and consuming these products, perhaps maybe even low income, or those relying on government assistance and SNAP and food stamps, and obviously so on and so forth, the changes that are likely to occur with RFK Jr. at the helm. And it's not the largest font, but I think it's the most important. Market Watch, above this headline of a $500 billion wall of money that is going to sweep the stock market higher in the second half, according to JP Morgan, is directly below need to know. And folks, I really think you need to know.
For those who are unfamiliar, fiscal dominance or government policy dominance happens when a government's debt is so large that the central banks, when they adjust interest rates, it has no effect. But as always, don't just take my word for it. I'm just some guy on the internet. Go ahead and look it up for yourself. But just to recap, taking a look at this chart above here showing the debt to GDP ratio in the United States going from where we're at right now all the way back to 1900, we can see that post-World War II, the debt to GDP ratio was around 106%. And this was very high. Debt was high, inflation was high, and when there was a really big problem with fiscal dominance, meaning that government spending was overtaking any type of efforts by the central bank to raise or lower interest rates. Now, when you see debt to GDP, think about it similar to how you and I both have a debt to income ratio. Whenever you're applying for a mortgage to buy a house, the banks want to see how much debt you have to service versus the amount of income that you make. If you have a lot of debt compared to your income, then the bank sees you as high risk and vice versa. Now, jumping forward to today, even before this big Trump bill, the deficit trajectory was already out of control. And even though the White House claims that this bill slashes deficits, it's ultimately going to add another $3.3 trillion to the deficit on top of the unsustainable trajectory. And with this added spending, going back to a chart of the debt to GDP ratio, Yale did a forecast showing that the debt to GDP ratio over the next 30 years is about to go parabolic, well above the 1940s peak level. And this is all happening at a time that the inflation rate is nowhere near the Fed's 2% target. And this is why the Fed is completely stuck right now. If they raise rates, then debt explodes higher faster. If they cut rates, then inflation goes back up. And if they stay where they're at, then growth continues to slow. And so the government has to do something fast in order to get down the debt to GDP ratio, which if you remember second grade math, there's only two ways to reduce a ratio. You either decrease the numerator, which is decreasing the debt, or you increase the denominator, which is increasing GDP or growth. Now, looking back at the post-World War II era, they reduced the debt and grew the GDP because you had all those troops coming back to the United States, and so you had a huge labor boom. But that first initial shock of that debt to GDP ratio reducing didn't come without any type of pain, as there was a 3-year bear market before exploding to new all-time highs. But because the stock market pretty much has a 1-to-1 correlation to government spending, I think when Trump tried to reduce some government spending back earlier this year and saw the market crash, he realized he cannot do this. And so what's the ultimate answer that the government always goes back to? Burn the dollar. And we're pretty much already seeing that with the way the dollar has been performing this year. And unless we get some sort of AI productivity boom miracle, interest rates are going to remain near 20-year highs, and we're more likely than not going to have some type of hard landing. But until that point, I'll keep owning assets that do well in stagflationary conditions, such as gold, Bitcoin, select stocks, as well as commodities.
Some political news that media outlets and especially Democrats are not talking about. Number one, our stock market is at an almost record-breaking high. Numbers so high that CNN actually called them remarkable. This goes for Dow, S&P, NASDAQ. Basically, the entire market is just booming and again, almost surpassing its record. Number two,
The government is crashing the economy, and the rich is going to take advantage of it by buying valuable assets at a lower price and then selling it back to us at a higher price for a profit.
The 1% are about to get way richer. And it's not because they're smart. It's because they know that these three things about this big, beautiful bill that the rest of the world just doesn't know yet. Let's break it down. This legislation is going to supercharge asset prices, widen the wealth gap, and quietly reshape your financial future. But if you understand what I'm about to break down, then you have an opportunity here to move up the financial ladder. So let's break down what the 1% know about this bill and what you can do to take advantage. First, you know how this big bill is giving tax breaks to the rich, right? What the 1% know is exactly what this actually means for the economy. When wealthy people get tax breaks, they don't take that money and buy cars. They take that money and they buy companies. Economists call this the marginal propensity to consume, which means that the richer you are, the less likely you are to recirculate money into the economy. And instead, that money is going to go into assets like stocks, real estate, private equity. And in this case, you have to keep an eye out on crypto.
But nobody wants weak crypto rules more than the President of the United States. A majority of President Trump's wealth, as much as $7 billion worth, is now based in crypto, from issuing his own stable coin, to issuing his own meme coin, to owning a Bitcoin mining company, and to controlling a huge portfolio of crypto investments.
So when a bill lowers taxes or increases incentives for the rich, that money's not going into small businesses or Main Street. No, that money is going straight into Wall Street. And if you don't own assets, then you're not even in the game. The second thing that the 1% understand about this bill is the impact that it's going to have on the real inflation. Now, I know that we've been taught to look at inflation as the price of groceries or the price of gas at the gas station or eggs. But in reality, that's a complete distraction. The real measurement of inflation is the price of assets. And as demand for these assets continues to rise, the price will as well. And as that occurs, it's going to be even harder to purchase your ticket into the game, so to speak. If you do not own income producing or appreciating assets at this point in time, it's only going to get harder moving forward. The third thing that the 1% understand about this bill is that it's going to inject another $3 trillion in the national debt over the next decade. And that debt's going to have real consequences. Foreign investors have already stopped buying U.S. treasuries at the same rate that they have in the past. And what that means is that the actual rates in the market are rising to compensate for that decreased demand for the treasuries. As the demand for bonds decreases, there's also a decrease in the demand for dollars that you would need to use to buy those bonds. And therefore, the value of your dollar is going to be continuing to decline on a global stage as the bond market cools off. When the dollar declines, hard assets, precious metals like gold, commodities, foreign currencies, and even foreign equities have a real chance to continue to rise as this rotation away from the United States or US dollar continues to occur. So let's quickly recap. First, the fact that the tax breaks are going to the rich means that they're not going to be spending that money in the economy. Instead, they're going to buy assets. The second thing is that with this increased demand for assets, the price of entry into the game of investment is going to continue to rise as time passes. And third, as the United States massively increases its national debt, the value of the dollar is likely going to decline. So you have to be prepared for that kind of scenario, folks, and what that means for you and your wealth as an investor. If this all sounds like a foreign language, it's okay. Here in the United States, they don't teach us this information. And what I'm going to do is I'm going to break down all of these macroeconomic concepts step by step on a series for the members of the channel. So hit that join button. Next, if you're just feeling lost in general, what I need you to do is to develop a plan. Down below in the description, there's a link that will grant you access to the systems that's going to give you what you need to first off figure out exactly what it is that your next steps are, and to secondly, develop an entire wealth plan based around what it is that makes sense for you. Now, I don't care how you do it, but what I do need you to do is to develop a plan.